Hello, everyone, and welcome to this week's podcast. We are currently recording this on July the 14th, but it'll be released on July the 15th, Friday. So taking a look at Thursday's action currently and what we've seen transpire this week, it's been eventful, to say the least. Looking today, just on that chart of the S&P 500, looking at that 25-point per box chart, we see that the S&P 500 will break a triple bottom at 37.25 and return to a sell signal. So now we keep an eye on support there at 36.50, and really that's pretty significant support level that dates back to December 2020 if you look far enough back on that chart. But recently we saw it rebound off of that support level back in June before we saw many of the indices were start returning to buy signals here recently. So seeing some negative action within equities, but today our goal is going to primarily be talk about a number of things, say sort of a macro view, but we're going to start off with equities. And I know Will was talking to me a minute ago about the fact that earnings have been pretty interesting as well. As we noted, this is going to be the week of interesting things.
Yeah, I mean, it seems like they always come at the absolute worst time. It's like where you have inflation/recession coupled fears, then you have your geopolitical stuff. And let's just throw on earnings while we're at it. Think about a couple of years ago, I remember we were doing this and you had the COVID meltdown and then you had earnings, beginning of April. And then you had this huge June pullback and then, late July, here we come with earnings again. So it seems to never come at a good time. I really don't remember a fun earnings season personally. Probably dating myself a little bit there in the opposite way that most would. But these seem to never be a good time. Even if companies are doing well, it seems to just put some stress on the market. And you've kind of seen that today, I think, play out. JP Morgan being a pretty big name that came out with earnings this morning that were, in short, not well received by the market. They're cutting their buyback program mainly to supposedly hold funds in case they have to hold money for people that don't pay their loans. In short, high level view. So I think that cast kind of a grim shadow over the market. Morgan Stanley also kind of moving down at this time. Some of the other big banks are to follow later this week and into next week with some other big names. So overall, probably not the start you wanted from earnings, especially given the macro environment right now.
Not very much. I mean, and the thing we're seeing with a lot of the indicators is, we've seen some of those things like the bullish percents. Most are still sitting in X's at the moment, but we've also seen some of those shorter term indicators, such as the 10-week as well as the 30-week turn down. We still see the high low at low levels. So it really haven't seen a resurgence out of the indicators to give us any type of good push, if you will, either. And now with the indices returning to sell signals, we're sort of seeing, okay, here's why in a way.
And let me actually jump in on that indicator point for a moment. I was just actually talking to a guy on the phone about this, where you typically get to these indicators in washed out territory. We say, watch for reversals up. This is a good sign of demand coming onto the picture. It's probably historically near washed out territories as well. So not to say that that's not the case now, but it's likely that we're going to get several shots to take new exposure on when you get these reversals up from low field position. You typically do get a lot of chop around here. I would say too, this is not to be ominous here, but a lot of those numbers are very positive when you get reversals up from washed out territory, like the bullish percents and the high lows. But there's always an exception. It's never that 100%. And take this with a grain of salt, but it was 2008, 2002 that keeps coming through every single time when we look at these indicators coming out from this territory as the exceptions to market environments where that wasn't the case. And it wasn't necessarily that you went down significantly more from these levels. You just kind of chopped and went nowhere for, 9 months to a year after that. So not to say that's going to happen, but those are the exceptions.
Also experienced a tremendous amount of volatility in the process, which is sort of,
true.
Where we're at now, and looking at a lot of just asset classes right now, you're seeing just volatility out of price movement. And there's not one in particular that's immune, if you will. There's one that's probably faring better than most right now. And it seems like this week we've talked a lot about it in our report, and really, it even to some of you who've read the report this week, it may sound like we're being a dead horse in a way, but it's really one of the few positive things to talk about, and that is the US dollar. So looking at that DX/Y chart, I mean, we're seeing that chart trade up towards 108 at the moment. It's given how many consecutive buy signals here? It really has been on a buy signal. Yeah, has been on a buy signal since February, or it looks like maybe March of 2021. So haven't seen it give a sell signal since. When you look at something like UUP, which is that Invesco bullish dollar fund for potential exposure, with today's action, UUP rallies up to a level that we haven't seen on it since November of 2002.
Decades.
Few decades. If we really wanted to dive into showing our age, Will, we could talk about where we were in 2002. Mm-hmm. Needless to say, we weren't studying the markets.
They can probably guess. Yeah. They know.
No, they know. Nonetheless, I mean, we're seeing the dollar rally pretty significantly. It's continued that trend for much of the year, but something that we've seen begin to sort of cause ripple effects recently has been the effect of the dollar and on commodities. Because I mean, really, that trend had been bucked for much of the year. We had just seen commodities charge right higher while the dollar was moving higher. And we sort of, in many ways, were saying, okay, like you were talking about earlier, thinking of exceptions, maybe this is an exception. But recently, especially in the past like 3 weeks, with starting with sort of an initial breakdown in crude and what's continued to be somewhat of a breakdown in crude, that has begun to change. We have seen some of those signals move away from commodities within Dolly. We've seen it give up some of that strength within asset class group scores, and specifically looking at, like crude oil proxies within Dolly. One of our crude oil proxies that we look at has actually given an RS sell signal versus the dollar for the first time in what technically is not quite 9 months, but and that may not seem like it's shocking, but it's one of those things that it isn't all that often that you see the dollar, gaining RS buy signals in many ways, especially within Dolly. Historically, currencies have tended to stay down there in the bottom. Rising dollar environments, some turbulent markets, you see RS relationships tend to switch to favor the dollar. And that's sort of where we're seeing right now. And because the dollar has continued to rally, we're seeing some of those relationships continue to move away now from commodities. But the dollar's picked up signals for much of the year, and it's sort of got commodities in its sights, if you will, ready to go and see if it can take it down now as well. Because I mean, there's still some of those places within the commodity space, mainly just broadly energy speaking, as well as broad agriculture, that are still hanging on at the moment versus the dollar. But I mean, it's not, we've already seen the impact. We've already begun to see those ripple effects felt. So that's really one of the big things we've talked about this week. And we definitely wanted to bring that to your attention. And, the fact that we're seeing really the dollar be one of the few asset classes that you can look at right now for some positive performance. And that's part of the conversation that I know I've had some this week.
Yeah. I mean, it's tough from an asset allocation perspective to say that, all right, equities aren't working, commodities are no longer working as well, as go buy the dollar. That's really not, it's like take your equity exposure and go buy a currency. That's a really tough thing, I think, to do on a broad scale right now. But a further note on the commodities ripple effect that you've seen that breakdown, that's kind of the lone area of the market that was working for a while. So stripping that away, I think, is going to put people in a lot of tough positions. Like where do you go now? I would say within commodities, it's not all bad right now. Energy, precious metals, industrial metals all look pretty poor at the moment, if just very washed out, oversold, so maybe get some meaner versions. But longer term agriculture, like you mentioned, David, I think is still hanging in there decently well. It's got a more attractive, I think, risk return profile than some of their other areas do. So that could be an opportunity within commodities. And then even within domestic equities, I think right now it's just narrowing leadership and kind of funneling down, whether if you're in domestic, it's more defensive sectors. If you're in commodities, maybe it's more agriculture.
Yeah, and I mean, looking at most of those commodities, even with yesterday's action, we did see crude symbol CL/break a spread triple bottom there at 95. So still, as Will noted, still seeing it break down, still seeing it move into oversold territory. So potential for mean reversion bounces is there. And out of many of these, we'll sort of, I guess, in a way, see how after a potential mean reversion bounce, where we go from there with a lot of these commodities. Do we see that baton still carried by the asset class, or is this sort of that first shot over the bow that we're seeing it giving up its leadership? We don't know yet, but
Yeah.
it is
Yeah.
something that we'll be paying quite a bit of attention to that for sure.
Yeah. Yeah. And specifically on that crude chart, I think it's going to be tough to get out of the support range that we're getting close to, David. I know you've mentioned it on some of our morning briefs, but we're looking at that crude chart, and we'll throw this on YouTube if you're watching, but really in the low 90s, there's a lot of support there that could be tough for that to penetrate and break through to the downside. If you do, there's not as much support. So maybe you do get a bit more into a free fall. And looking at yesterday, so like CPI, energy is a big portion of that CPI. So you would think crude prices coming down actually materially would probably be good for the economy and good for the market at large. But these kind of interim movements, I think, still keep it pretty muddy, whether that'll amount to a positive or not.
Muddy waters describes it
Yeah.
best. We still haven't gotten any real direction out of the Fed, and it seems like once they find a direction, they're having to make a reactionary move after that because either data's not following in line. I mean, I know inflation numbers were higher than expected, and that potentially sort of drove a lot of this thought that we're going to see this 100 basis point rise, but we still don't know for sure at the moment. And looking at like that TNX chart, we actually see that with today's action, which is that 10-year yield index chart, it reverses down into at 29.5, which is 2.95%. And what we actually talked about this before we started the video, the fact that TNX chart is setting up a potential triangle pattern at the moment. If it broke to 2.85%, that would be a pretty significant breakdown. It would complete a bearish triangle on that TNX chart. And then we're kind of monitoring support there at 2.75% or 27.5 on the chart. So those are things that we would keep an eye on as we move into tomorrow with where will we see rates go from there. Those are support levels you can keep an eye on from there. If we saw a reversal back into X's move above really 3.1 would break a bullish triangle. So, setting up a triangle pattern on that TNX chart is going to be pretty interesting as we go. Well, it is interesting as we move into tomorrow and await what the Fed will tell us.
Yeah. I mean, maybe end of the week summary, if I were to give one and things to watch as you come into next week, like David just said, stick with TNX. I think watch this kind of triangle formation, look for support in that 2.7% range. I think that'll be important. From the other areas, like crude oil, low 90s support. If we can get some stabilization in there, I think that would probably be expected based off the technicals here. Also commodity related, we didn't talk about it today, but copper, that's still in free fall right now. I feel like every morning I check and it's just down or has been down. So you're getting close to your September 2020 levels. I think that's a pretty important level to watch from market memory, at least. And I've been reading that sometimes you see industrial metals lead in energy and directional moves, whether to the downside or upside, given that they're a bit more core to economic productivity. So watch copper as well in relation to commodities that are, I think, have a pretty good pulse on the market right now. And then zooming out to equities, again, maybe just focus on the S&P, this 3,700 level that we've been chopping around for a while. We've shot over, shot under, like David said, broke today at 1650, or excuse me, 3750, 3650 today. So watch that 3700 level, 3600. We seem to be consolidating in that range. It was your March 2021 pullback levels. After that, you don't really have a lot of material support on the major index. So I think that's going to be pretty key to hold here. The breakdown a leg lower could put us in a bit of a different regime.
Yeah, and really looking at that S&P chart, the number I continue to monitor, looking at it as you and I look at this chart pretty much every morning. 3,500 to me is that real long line of demarcation that I've been keeping an eye on for months now. So, that's a very long-term level. We still got quite a bit of support between here and there.
Yeah.
But
I mean, what is that, like November 2020 COVID announcement or COVID vaccine?
Yep.
Yeah.
That's when you saw
that'll
that.
be interesting.
We will keep an eye on it, but as we will continue to keep an eye on many things to close out this week and move on into next week, finish out earnings, some earnings this week. We have another big earnings week next week, I believe.
Yeah.
So have a lot of things happening to finish this week and move into next week. But as always, we will bring you up to date to anything that we see change on the platform with it, whether it's relative strength, asset classes, so on and so forth. And join us again next week for our podcast then. And as always, thanks for joining us.